again, everyone. This is Gene Ahrensberg coming to you on Monday, May 20th, 2013. Well, this past week, gold turned lower again after pausing in the 38.2% to 50% Fibonacci box. The bears seemed determined to do a retest of the April 16 lows near $1,321. Gold finished the week off 6.1%. Silver answered lower, down 6.8%, and mining shares were chunked overboard in a big way. The Huey fell a big 12.1%, and the Market Vectors Junior Gold Miners Index, or GDXJ, was clocked for another 14.2%. You know, some of our colleagues, like Rick Rule of Sprott Global, have said that they just haven't seen a final capitulation event. It seems to us this is the kind of action to look for in a capitulation event, where people are just chunking miners overboard like so much chum, sick to death of holding them and watching them do nothing but crater for the last 2 years. We argue that the graph has become parabolic to the downside. Just like parabolic advances, once the momentum changes, there's usually a major correction coming. The only question is when, not if, that reversal occurs, in our opinion. There's almost always a sector that is out of favor in any market, and we're looking at one that's not only out of favor, it's pretty much hated about now. I would say the miners are about the most hated sector in the equities markets today. Mining shares are a contrarian's playground. There's a good reason for that. Gold has been weak for a long time, as gamers and investors have been moving away from the yellow metal to chase the big markets, like the Dow or the S&P 500, which are red hot. I don't know if the people doing the moving out of gold actually believe that the world's central bankers have everything under control, or if they are just chasing what seems to be working right now. I'm guessing some of both. It takes a ton of buying to keep a very large market moving higher. It takes institutional money, pension money, endowment money, traders, gamers, and their brothers and their mothers to put an entire market up. Add in foreign inflows from places like Japan, where the government is out to destroy the purchasing power of the yen, and from Europe, where the EU has shown its subjects that the bank deposits are no longer safe. Add in that foreign money to the mix and we get a runaway bull market in U.S. stocks. For now. We can't express strongly enough the sense of irony we feel around here when we consider that it is the Fed pumping $85 billion every single month into the markets that has levitated the Dow and the S&P and given traders everywhere a false sense of security. And yet gold, which should be the beneficiary of a debased fiat dollar, continues to fall in price, in dollar terms, as if all the extra currency units being created out of thin air to buy U.S. Treasuries and mortgages didn't exist, and as if the Fed were canceling $85 billion per month of currency units instead. With that as kind of the uncertain intro, and with gold and silver selling down again, what can we see in the changes of the largest traders of gold and silver futures? This week, I'd like to begin with the Legacy Commitments of Traders report, and focus this time on the traders, the CFTC classes, as commercial, the natural hedgers, including bullion banks. To set the stage, this is the FinViz chart of gold in hourly terms to show the COT trading week, remembering that the COT data is released late Friday afternoon for data as of the close on Tuesday. In this case, it's Tuesday, May 14th. As you can see, as of the close on Tuesday, gold had drifted lower, but after the COT cutoff, the sell-down accelerated. So the data we are about to review occurred as gold was only down marginally. For the calendar week, gold was mistreated by nearly $90 the ounce. But from the COT Tuesday to Tuesday, it was down, but only by $27. With that in mind, this is our tracking data table for the traders, the CFTC classes, as commercial in the Legacy Commitments of Traders, or COT, report. The commercials include the producers, merchants, processors, and users, as well as the swap dealer commercial traders combined together into one group. This is the category which includes bullion banks, and all those in the gold trade that literally have to hedge their exposure to gold volatility. Sometimes we just call the commercials the big hedgers. Without exception, since the gold bull market began in 2001, the big hedgers have always been net short gold. We track the big hedgers because over time their positioning opens a window into how the largest, best funded, and presumably the best informed traders of gold futures are positioning for their own book and for their clients. More about that in a minute. This week, for example, as gold declined $27.12 an ounce to about $1,425, collectively the big hedgers reduced their net short positioning by 3,573 contracts to show just 84,146 contracts net short. Now, 84,000 contracts may sound like a lot, but wait till you see the charts in a minute to make any judgment on that. So as gold fell 1.9%, the big hedgers covered or offset another 4.1% of their net short positioning. By itself, that's kind of normal. We expect to see the hedgers reducing their net shorts as the price of gold declines. It's when we take everything in context that it begins to tell us a story we can usually use. Notice, please, that since October of 2012, as the price of gold has been grinding lower, the large commercials have been doing a lot of reducing of their net shorts. To put some numbers to it, since October 2nd and as of Tuesday, May 14th, gold had fallen a net $349 or 19.7%, from $1,774 to $1,425 an ounce. Over the same period, the combined commercial hedgers had reduced their collective net shorts by 185,124 contracts, or 69%, from a very high 269,270 to just 84,146 contracts net short. Let's look at the graph to see it visually. This graph is the nominal amount of big hedger net short positioning, or LCNS. In October 2012, when gold was in the 1770s, the big hedgers, which include bullion dealers, refiners, jewelry manufacturers, producers, and the bullion banks many of them end up trading through, had a pretty high number of hedges then, 269,270 contracts net short. On Tuesday, May 14, 2013, after gold had been sold off $349 or about 19.7%, the people in the gold trade who try to hedge out the risk of a falling price of gold had covered or offset nearly 70% of their hedges, all the way down to a very low 84,000 and change contracts. What is this graph telling us? Well, for one thing, notice that the current level of hedging is extremely low on the graph. In fact, we have to go all the way back to November 18, 2008 to find a lower net hedge position for the large commercial traders. Just 71,116 then, with $738 gold during the 2008 panic and genuine fears then of a full-blown global banking collapse. It should be obvious, but what this chart is telling us is that the big hedgers are not motivated to put on hedges now, and in nominal terms they have an extremely low number of hedges for gold. That's the same thing as saying that the big hedgers, including bullion banks, are a ton less fearful that gold will fall further now that it has already fallen about $350 since October. Now, this chart is in nominal terms. Let's go back to the table for a minute to look at one more thing. In order to standardize the data, we compare the large commercial net short position to the total open interest on the COMEX. That gives us a better impression of the relationship of the large commercial net short position, how it relates to the entire COMEX market. We call this the LCNSTO, or Relative Commercial Net Short Positioning. This week, for example, the 84,146 contracts net short equates to just 19% of all the contracts open on the COMEX, a very, very low level. For comparison, back in October, when the big hedger commercials then held 269,270 lots net short, the open interest was then 480,000 and changed, so the LCNS was equal to an extremely high 56% of all COMEX contracts open. So as gold fell in price from the 1770s to the 1420s net, the net shorts held by the big hedgers fell from 56% to just 19% of all COMEX contracts open. Let's look at it in graph form. Since October of 2012, the relative commercial net short position of the large commercial traders has gone from a very high and very bearish 56% all the way down to a minuscule and should be bullish 19% of all COMEX contracts open. That is, unless, of course, the tectonic plates beneath us are shifting in a material way, and unless we are entering a period where the commercials will end up being net long gold, with the speculators, the hedge funds, and smaller traders favoring the short side of the market again. That's a condition we have not seen since the last time the commercial traders were net long gold, all the way back in 2001, when the great gold bull was trying to get underway. Incidentally, the last time the big commercial hedgers were net long gold was on December 11th, 2001, 3 months after the 9/11 tragedy. The commercials were net long 13,626 lots then, 12 years ago, with $272 gold. Back to the more recent graph, what we can see is that as of this past Tuesday, with gold having tested as low as $1,321 on April 16th, then clawing back up to $1,425 on Tuesday, the net short positioning of the big hedgers as a percentage of the entire COMEX book is now lower. That's lower than it was during the panic sell down in 2008. For those keeping score, the lowest commercial net short position during the 2008 panic came in at just 69,496 lots on November the 11th, 2008, with $731 gold. The lowest relative commercial net short position was also that week, with 23.7% of all COMEX contracts open. It is 19% now. We have to believe that the largest, best funded, and probably the best informed traders of gold futures on the planet have positioned as though they see little chance of additional downside in gold. Because if the hedgers, whose job it is to protect their inventories from price drops in gold, thought that gold was heading much lower, we would expect their net short position to be a much higher percentage of the open interest. Let's point out that today's relative commercial net short positioning is similar to how the big hedgers were positioned during the 2008 panic and the last very important major turning low for gold. Important lows for this indicator often correspond with important lows for the price of gold. With that in mind, and with the basics of the Legacy COT report known, let's breeze through the same statistics for silver futures. Like with gold, we're tracking the positioning of the large commercial traders in silver futures as reported by the CFTC. This week, as silver fell 56 cents or 2.3% to $23.38, the large commercial traders, including the bullion banks, reduced their collective combined net short positioning by 1,238 lots to show just 13,218 contracts net short. That's a pretty low number, folks. And like with gold, if we look back in time a bit to December 4th, the big hedgers then held a very high 58,514 contracts net short, with silver then $32.91. Since December 4th, silver has fallen a net $9.53 or 29% as measured on Tuesdays. During that period, the large commercials, including bullion banks, have covered or offset a whopping 45,296 contracts, or 77% of their collective combined net short positioning. In terms of the number of ounces that represents, back in December, the big hedgers held a net short position equal to 293 million ounces. As of this past Tuesday, they had net hedges of just 66 million. Or 227 million ounces less hedged today. Let's look at the nominal LCNS graph. What we were just looking at in table form was in December the big hedgers held a very large 58,514 contracts net short, with silver at $32.91. But as silver has sold off 953 or 29% to a low 23 handle, the large commercials have covered or offset 45,296 contracts, or 77% of their net hedges, down to just 13,218 contracts net short. That's getting pretty close to their lowest net short positioning last summer, an 11-year record low of 12,011 contracts net short then, with silver then testing $26. Since Tuesday, silver has moved lower to a low $22 handle on a closing basis, so we might reasonably assume that the silver LCNS is now even lower than last summer, although we'll have to wait for the next COT report to find out for sure. Let's look at it again in relative terms. Like we do with gold futures, we compare the large commercial nominal net short position with the silver open interest. That gives us an idea of how the LCNS compares to all the action open, and over time that standardizes the nominal data. As of Tuesday, with silver at a $23 handle, the relative commercial net short positioning had fallen from a high 41.3% last October, when silver was then just under $33, all the way down to just 9.1% of all COMEX contracts open. Looking back over the immediately available data that we have in our database, which goes back 13 years to the year 2000, we cannot find a lower relative commercial net short position for silver futures. We're certain that there has been a lower LCNSTO at some point, but there has not been one in the last 13 years. Bottom line, with silver at a $23 handle, the big hedgers have gotten very small in their collective net short positioning, both nominally and as a percentage of all the contracts open on the COMEX bourse. Another way of saying that is that the largest and best funded traders of silver futures, including the bullion banks many of them end up trading through, are not positioned as though they believe silver is going materially lower, with silver down here in the $23 neighborhood. That doesn't mean that the big hedgers are right, in the sense that they are positioned as they were for the last big reversal. It doesn't mean that the great gold and silver bull markets are not transitioning into a new long-term bear market. They could be, of course, despite our own belief and understanding of the fundamentals, which look to us just as bullish as they were in 2011, when gold tested $1,923 and silver got pretty close to an all-time high near 50. Momentum in markets can be kind of like an aircraft carrier when it comes to getting it turned around. Once you have that flat top heading in one direction, it takes a lot of ocean to bring it to a stop or to turn it 180 degrees. Nothing says that the very bullish positioning we see in the big hedger positioning today can't get even more extreme than it already is. And the gold and silver bears smell blood in the water, with the April lows within spitting distance of the close on Friday, May 17. And if the gold and silver markets were to bust through those important panic lows, it could ignite another round of sell stops and trailing stops, maybe even challenging the next level of the Fibonacci retrace zone for gold, the 50% retrace level. Call it something near $1,100, which would be about 43% below the 2011 peak and roughly equivalent to the major pullback for gold we saw in 1976. Just before gold really caught on and ran up eightfold 4 years later. At any rate, gold fetched up and caught a bid overnight on Monday, May 20th, so maybe we don't have to worry too much about that 50% Fibonacci target. While we really don't expect to see that much of a retrace now, with the large commercials having so small a net short position in both gold and silver, which of course means they don't expect to see it either, and with there being so much unnatural short covering horsepower in the futures markets today, as we mentioned in our weekly chart updates this week, it seems to us the largest, best funded, and presumably the best informed traders of gold and silver futures on the planet are positioned like they were the last time there was an important major turning point for both gold and silver. It seems to us as though those veteran traders expect gold and silver to catch a bid in here sometime soon, in other words. Right or wrong, win or lose, we re-entered the silver market Sunday night, as mentioned in the daily comments. Stay tuned to the charts and our daily commentary for more looking ahead. Thanks for watching, and we'll see you all again next time. Bye for now.